Well, now we're going to go through a practice exercise on flexible budgeting. The real advantage of flexible budgeting is to generate an analysis that would tell us what the activity variances are. That's activity is the key word. The activity variances are generated by the difference in the level of activity between a static budget, or one that we've maybe put together months ago for the current year, versus a flexible budget, which would take into account the actual level of activity in the current operations. Now, for our practice exercise, we're using the one that has been provided to you via a PDF document on the Galligan Corporation. Galligan bases its budgets on the activity measure for customers served. In their July operations, they planned in their original budget to serve 30,000 customers, but they actually served 34,000 customers during that month of July. In your information that was provided to you, they provided the following information relative to the revenue and expenses, both fixed and variable per customer, and these are the amounts that were used to put their original budget together, both for fixed and for variable. And in your information, they also provided you the actual results for the month of July based on the 34,000 that they actually had in terms of customers, but they gave you the actual revenue and the actual expenses. The requirement here is to prepare a report that shows the activity variances for July. Now, the common fault here that most companies fall into, or the trap they fall into, is they compare their original budget to the actual amounts in a given month. And then at that point, if they do that, they're not able to break out what we call the activity variances versus the revenue and spending variances. If they first go through the exercise to calculate the activity variances, they will have the dollar amounts that are as a result of the differences between serving 30,000 customers versus 34,000 customers, or serving 34,000 versus the original 30,000 that they had planned. So let's take a look at what our analysis will look like. We will use the expense categories in the revenue line, but we want to, and we'll also use the fixed expenses and the variable rates that are used in the original budget. But we will prepare two columns, one for the static or the original budget and one for our flexible budget. The static budget will be based on the level of activity that was budgeted originally, perhaps months ago, that we anticipated for that month of July. And the flexible budget will be based on the actual level of activity in the current month, which happened to be 34,000. So based on their budgeted rates, they should have generated $136,000 in revenue in the month of July based on the 34,000 customers, if in fact they had revenue at $4 per customer. Now, the data that was provided to you indicated that the company only generated $134,200. Notice that we're not using the actual amounts on this schedule at all, because what we're trying to calculate are the activity variances. We're not yet ready to take into account anything related to the revenue and spending variances. So the way this calculation works, or the way this schedule works, is that using the fixed expenses and the variable rates, we're able to calculate what the original amounts would be in the budgeted column based on the 30,000, and we're able to compare that to what if we had budgeted using 34,000 versus 30,000, what would the budget have been? In other words, a flexible budget. So in this case here, if we take the $4 per customer times the 34,000 customers, we will get $136,000 in revenue versus the $120,000 that was in their original budget. Similarly, if we, on wages and salaries, in this case we have a fixed amount of $35,100, and in addition to the $35,100, we will incur wages and salaries of $1.30 per customer. Multiplying that $1.30 times the 30,000 and then adding the 35,100 gets us the 74,100. So the formula is the fixed expenses plus the activity level times the variable rate. Using that same formula but increasing it to 34,000 customers generates roughly another $5,000 in expense. So that becomes 79,300 under the 34,000 flexible budget. Using that same formula or that same theory, in the case of supplies, there is no fixed amount, so it's the 80 cents times the activity level in the case of the static budget and the flexible budget. We then go down the worksheet and complete the budgeted amounts for each of the static and the flexible budget. We then compare those to each other row by row to determine whether we have activity variances that are favorable or unfavorable. In the case of revenue, we do have a favorable variance because we had 4,000 more customers. So our activity generated an additional $16,000 in revenue based on the budget rate of $4 per variable rate. So activity-wise, and bear in mind only activity-wise, we should have a positive or favorable variance of $16,000. Now I mentioned that the company only had $134,000, so that indicates that they did not generate revenue at the $4 level per customer, or they would have gotten a little bit more revenue. So that will, in fact, once we determine the activity variances, we'd then be able to move on to a further analysis to generate spending and expense variances for revenue and spending variances for each of these items as well. But here we have a revenue that's favorable. Now in the case of the expenses, they will generally be unfavorable because to the extent we have variable expenses or variable expense rates and we have more customers, that will generate an increase in expenses over what we originally budgeted. So activity wise, yes, we're going to have $5,200 more wages and salaries than what we had originally budgeted months ago. So this analysis would tell us the favorable and the unfavorable elements to the activity variances, and in this case we have a net operating income favorable net activity variance of $7,200. Hope this is helpful in explaining the differences between the flexible budget and the static budget that generate activity variances.